Intel just dropped its latest quarterly numbers, and on the surface, they look incredible. But the big question everyone's asking is this a real comeback or something else entirely? Let's dig in. All right, so let's jump right in. Intel's third quarter. Wow. At first glance, it looks like a total home run. But you know Wall Street? They can't make up their mind. Is this the comeback we've been waiting for? Or is it just the calm before another storm? That's what we're here to figure out. What is really going on behind these big, flashy numbers? So let's start with the good stuff, right? The top line. Revenue for Q3 clocked in at a really solid $13.7 billion. Now, that's not just up 3% from last year, it also smashed Wall Street's expectations by a full 4%. You gotta call that a win, no two ways about it. Okay, but then you look at the earnings per share, the EPS, and this is where things get kind of wild. The non-GAAP number came in at 23 cents. And by the way, non-GAAP just means they've pulled out some one-time expenses to give you a cleaner look at how the core business is doing. So, 23 cents, why is that a big deal? Well, get this. Analysts were only expecting 1 single cent. Yeah, this wasn't just a beat. It was an absolute blowout. And just when you thought it was over, here comes the final punch, gross margin. Non-GAAP gross margin hit 40%. I mean, that is a huge 22-point jump from last year, and it came in 400 basis points. That's 4 whole percentage points higher than what the experts were predicting. So you've got revenue beat, EPS blowout, margin surprise. The numbers look amazing, which leads to the obvious question. How on earth did they pull this off? Right, so how did Intel deliver such a massive beat? Well, here's the twist. The story of this quarter isn't really about some sudden miraculous turnaround in their day-to-day operations. No, it's actually about something, well, a little more financial. It's about a massive reshaping of the company's balance sheet. Okay, get ready for this. During the quarter, Intel managed to pull in an absolutely staggering $16 billion in cash. So, where did all that money come from? Well, you've got a big chunk from the U.S. CHIPS Act, funding that came in faster than expected. Then you've got major investments from, get this, NVIDIA and SoftBank. And as if that wasn't enough, they also sold off parts of their Altera and Mobileye businesses for another $5 billion. So the big takeaway here? This quarter was absolutely flooded with cash. And that brings us right to the heart of the matter. You see, all that cash, it's not just for making the bank account look good. You can think of it like a giant financial bridge. And Intel built that bridge for a very specific reason, to get them across a really deep, really dangerous chasm in their core business. Because once you look past those shiny headline numbers, the same old problems are still there, lurking underneath. Let's be real, Intel is still losing ground in the super important server market. Their massive bet on building a foundry, it's burning through billions of dollars. And their AI chip, Gaudi 3, it's barely making a dent in a market that's just completely dominated by somebody else. Okay, so let's pop the hood and take a look at the actual product groups. And what you find is, well, it's really a tale of two Intels right now. Two very, very different stories. On one hand, you've got the one definite bright spot, the client computing group. You know, the folks who make those CPUs for all our PCs and laptops. Their revenue was actually up 5% this year. And that's happening because there's this big PC refresh cycle going on. Basically, tons of businesses are having to buy new computers before their old Windows 10 machines become obsolete. So good news there. But then you have the other side of the coin, the data center and AI group. Their revenue actually shrank by 1% from last year. And look, I can't overstate this. This is a huge deal. The data center is everything right now. It's where all the growth is, it's where the big profits are, it's the future of computing, period. And if you're wondering why that's happening, well, you just have to look at the market share numbers. In the server CPU space, Intel's slice of the pie has dropped to just under 73%. That's a loss of more than 3 points in just 1 year. And where did that share go? Well, their biggest rival, AMD, just scooped it up. They've climbed to over 27%. Believe me, every single point of market share lost in this business is a major, major blow. And at the exact same time, Intel is pouring an absolute fortune into building its own manufacturing arm, what they call Intel Foundry. Now, they don't give us the exact number, but analysts have done the math, and they figure that the Foundry business lost something like $3.2 billion in just 3 months. That is the staggering cost of trying to play catch-up in this game. So, let's just recap. You've got the core business facing some serious headwinds. So what now? Well, pretty much everything for Intel now comes down to one single, incredibly high-stakes bet on its future manufacturing tech. This isn't just a strategy. It's their moonshot.
The entire comeback plan, I mean all of it, hangs on this roadmap, and the start of the show is a new manufacturing process called 18A. Now, a process node is basically the recipe for making a chip. The more advanced it is, the smaller, faster, and more efficient your chips can be. Nailing 18A is absolutely critical because all their exciting new products, like the Panther Lake CPUs and the Clearwater Forest servers, they all depend on 18A being ready on time, working well, and flat out beating the competition.
And as you can probably guess, this huge bet has Wall Street totally split down the middle. You've got the bulls who are saying, hey, if 18A is a success, Intel takes back the crown. But then you have the bears, and they're pointing out all the massive risks. I mean, what if the yields are bad? What if they build this amazing factory and nobody else wants to use it? It is the definition of a high-risk, high-reward bet.
But then you have some analysts who are a little more cynical about the whole thing. One team at Bernstein actually wrote in a note to their clients, and I'm quoting here, "The real bull case seems to be that Trump wants the stock to go up." Ouch. But it really highlights just how much of Intel's story is tangled up in politics and government money now, not just making better chips.
Okay, so after all of that, what's the bottom line? If you're an investor or just someone fascinated by this story, what are the key things you need to be watching for? Here's maybe the most important takeaway from this whole quarter. That massive pile of cash we talked about, it didn't buy Intel a turnaround. Not yet, anyway. What it did buy them was time. Time to find out if this moonshot of theirs is actually going to work. So if you want to know if this is working, here's your checklist for the next year, year and a half. There are 3 critical things to watch. Number 1, do their new Panther Lake chips, the ones built on 18A, actually launch with good manufacturing yields? That's huge. Number 2, can they land a big, famous external customer for their new foundry? And number 3, does their AI chip, Gaudi 3, finally start to bring in some serious cash? If they can check those 3 boxes, then you'll know the strategy is for real. You know, at the end of the day, the 23 cents per share they earned this quarter, it's not the real story. In the grand scheme of things, it barely matters. The real question, the multi-billion-dollar question, is whether Intel can rebuild trust. Trust that Moore's law is still alive and kicking. And maybe even more important, trust in themselves, that they're the ones who can lead it. And for that, well, we're all just going to have to wait and see. I would love to hear your thoughts on that in the comments. If this breakdown helped your investing lens, like, share, and subscribe to The Chip Market, where we invest smarter in the world of chips.